My name is Mark Boud. I am the Senior Vice President and Chief Economist of Metrostudy. I'm here to share with you the most recent findings of the Residential Economic Report National Edition. At the heart of this report are modeled forecasts associated with the supply and demand of housing, as well as housing over and under valuation patterns. Mortgage interest rates have begun to climb. We predicted this back in third quarter of 2016, and they have gone up sharply since the election, and we expect them to continue to climb. Right now, they're about 4.2% in terms of 30-year fixed-rate mortgages. By the end of this year, 2017, we expect them to reach 4.75%. Our longer-term fixed-rate forecasts bring us to over 6% by year 2019, and thereafter we expect them to begin to level off as we forecast the national economy begin to slow. We expect consumer spending to continue to be strong during year 2017. It hit new highs during January of this year and is continuing to increase as employment increases and as energy prices remain low. New home construction continues to rise. Our forecast for housing starts for year 2017 is 1.28 million housing starts. We also set forth a more aggressive forecast with the hope that construction employment will be more readily available. That's at 1.4 million housing starts. If construction employment is less readily available, which could very well be the case, we lower our forecast to 1.225 million housing starts. By year 2019, we hit a peak level of housing starts at 1.515 million housing starts. These numbers sound high, but if you compare that to the peak year of 2005, where we hit almost 2.1 million housing starts, we won't come anywhere close to that during this current cycle. Because housing starts will remain relatively muted during this entire cycle, we expect that to influence residential remodeling activity. We've already reached new highs in terms of remodeling, and we expect remodeling activity to continue at high levels during the next 3 years. Driving all of this activity is continued healthy job growth. During the past 12 months, we've experienced 2.032 million jobs being formed in the United States. That's a bit lower than the past few quarters, but it's high enough to continue to drive strong housing demand. And that formation of jobs is likely to improve during year 2017 and 2018. We expect a tight labor market and high costs to begin to impact job growth, slowing it during years 2019 and 2020, with possible negative growth anticipated for year 2021. Unemployment correlates with consumer confidence. As unemployment goes downward, consumer confidence continues to increase. We're approaching levels of consumer confidence that rival those that were experienced during the previous cycle, and we expect consumer confidence to bounce between 120 and 125 during the next several quarters. In terms of demographics, the millennial generation will continue to increase in influence during the next several years as more and more of them begin to enter into home ownership. Corresponding with a tight labor market, we anticipate household incomes to increase at a more rapid level during the next 2 years, reaching a plateau by year 2020 and leveling off thereafter. All of this information is combined to produce what we call the residential economic model, which models the supply and demand patterns of residential real estate throughout the United States from 1990 going forward through our 5-year forecast. The blue curve represents housing supply as measured by Metrostudy and benchmarked to the census year every 10 years. The green curve is our modeled forecast of housing demand. When the demand curve exceeds the supply curve, it designates periods of pent-up demand, which we will likely experience at greater levels during the next 2 years. By year 2019, we anticipate the peak year in terms of pent-up demand. It will begin to recede thereafter as the economy begins to slow and as more housing supply is brought on. The other half of the housing model deals with housing valuation patterns. In the chart that you see here, the blue curve is a representation of median housing prices in the United States from 1990 going forward through our 5-year forecast. The green curve is where we feel the actual support of housing is in terms of valuation based upon economic, socioeconomic, and demographic fundamentals. The green curve begins to trend downward during the next few years, mainly caused by increasing mortgage rates. The gap between where prices are and where we think we should be represents that measure of overvaluation that we will likely experience. There is risk of housing overvaluation becoming fairly severe, not because prices continue to rise, but rather because mortgage rates are rising. That increasing cost of housing is what's causing this overvaluation to occur. We expect that overvaluation to peak in year 2020, thereafter beginning to recede and heading back toward equilibrium as mortgage rates stabilize and as housing prices may actually fall during what may be the next recession. These patterns of overbuilding and underbuilding and overvaluation and undervaluation are shown numerically in this chart, combined to create what I call the Opportunity Risk Index. It is this index which accurately forecasts the housing cycle for the next 12 to 24 months after the index is posted. Based upon this index, the next 2 years continue to be opportunity years in terms of both land acquisition and sales. But by year 2019, even though that may be the peak year of the housing cycle, it may be the first year to begin to consider the divestment of land assets. The overall cycle may continue to weaken thereafter due to high costs and weakening employment. Key takeaways for year 2017 are as follows. Job growth may increase both in year 2017 and in year 2018 from 2016 levels. Overall household income growth will likely accelerate, caused by a very tight labor market. Housing shortages will become more intense. Look for an accelerated and shorter, sharper real estate cycle with a peak in the 2018-2019 timeframe. An extended period of low mortgage rates has allowed home prices and land values to rise higher and more rapidly than they probably should have. Rising mortgage rates may contribute to severe housing overvaluation in many markets throughout the United States, despite only modest appreciation in these markets during the next few years. A higher national debt-to-GDP ratio will lead to higher interest payments, which will eventually dilute U.S. currency and slow the U.S. economy. And then finally, careful research and accurate data analysis have never been more important than in the current real estate cycle. The Residential Economic Report presents these modeled forecasts for every metropolitan area throughout the nation. For more information, visit metrostudy.com.